This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
This podcast is brought to you by The Felder Report. For every podcast episode I record, I put up a post at thefelderreport.com/podcast that features links, charts, and even full research reports discussed during the interview. So if you're not already familiar with the site, you're missing out. Go to thefelderreport.com/podcast to get the full story. You could say that natural resources run in Leigh Goehring's blood. The son of two oil and gas engineers, Leigh has spent nearly his entire life studying markets and investments related to commodities. Over the past 30 years, he's become one of the most brilliant and passionate analysts and money managers in the industry. In this conversation, Leigh discusses in detail his case for a major commodities boom dead ahead as part of a broader revolution in the asset markets. So I hope you enjoy my conversation with Leigh Goehring. Leigh Goehring, welcome to the show.
Thank you, Jesse, and thank you for having me back. You just reminded me that it was 5 years ago that we did one of these podcasts. So I'm glad that I've got the ability to finally make it back on your show.
You know, it's hard to believe that it's been 5 years because it doesn't feel that long ago to me. But at the time, you pointed out that we are witnessing a generational opportunity in energy stocks. Since that appearance on the podcast, the energy sector has generated a return of about 240% versus the 80% for the S&P 500 index. So I just have to first congratulate you on a terrific call and thank you again for being so generous with your time and thought process.
Okay, great. Excellent.
I want to get to energy again because I think that's a very interesting discussion today. But before we get to it individually, I have to say that reading your two most recent quarterly reports, I thought to myself, I have to bring Leigh back on. It's just been too long. And the case you make in those reports for a major commodity boom dead ahead is just super compelling. I mean, even after the rebound we've seen out of the COVID lows, commodities remain extremely cheap relative financial assets like the stock market. Isn't that right?
That's exactly right. And what's so fascinating about this commodity bull market, as you mentioned, Jesse, it's already started. Like, for example, you mentioned that the average oil index or whatever is up 240% since 2020 when I was last on your show, which is basically double the return of both the S&P 500 and the NASDAQ 100. And here's the fascinating point. Okay, so the bull market started, the stocks are outperforming, and yet there is no investor participation in this sector. And I'm gonna just point some of these fascinating statistics out. Like, for example, you look at all the energy ETFs, like the XOP, which mirrors the S&P Exploration and Production Index. That the open interest since 2020 is down. Get this, down 70%. The XLE, which of course is the big cap energy index, because it's got the Exxons and the Chevrons and all the refiners and things like that. That's down. The number of shares outstanding in that ETF is down 40%. The OIH, the oil service ETF, that's the open interest is down 70%. So the thing is that you can make the case that these stocks have outperformed over the last 4 to 5 years without any participation at all from investors. It has just been one huge short covering rally. And I know that it's hard to get your arms around and what that really means, but you could make that case.
Yeah, I mean, it's astounding. I mean, have you ever seen anything like this in your career where you've had such stellar performance and investors just shunning the sector like this?
Yeah, no, and I think that's where the opportunity is. And this type of indifference is, like you said, I've never seen it before. But here's another great example of it. Gold broke out, and I know we'll talk about gold later on the show. Gold broke out in the first quarter of 2024 after trading up and down for the previous 4 years. Gold since that time is up 55%, and I think it's probably the best performing asset class out there. The open interest of the GDX ETF, which is the big gold stock ETF that everyone uses, the number of shares outstanding in the GDX is down 30%, even though the gold price has risen 55%. So again, you could make the case, and you talk to people that run dedicated gold funds, and you ask them, have you seen any inflows at all recently? They said, no, in fact, we just stopped getting outflows, and now we're getting these tiny dribs and drabs of inflows. So the thing is that again, there's this market in gold stocks. I think during that same time period, gold's up 55. I think the GDX is up like 70, but it's all taking place in liquidation.
Yeah. So, I mean, so the sector, natural resources stocks generally are just, I mean, completely out of favor, totally shunned by investors. I think you point out in one of your reports that the weighting of natural resource stocks within the S&P 500 is just a little over 3%. And it's been
Yeah.
historically, it's ranged, from, I mean, this has got to be the very low end of the historical range.
Oh yeah. In fact, you're referring to that. That's just the weighting of energy in the S&P 500, and it's now I believe is just a tad below 3% today, which the only time it's been lower was in the depths of the COVID crisis back in April of 2020, and so this is the lowest level ever. I
Yeah.
would make the case, and it's a reflection of investor complete disinterest.
Yeah. Yeah. Well, let's get to yeah, I think why you believe now we have a very important catalyst for a commodities boom in the years ahead. I think in your one of your reports you point out there are two potential catalysts for a major commodities boom: a major monetary regime change and the unwind of the carry trade. Let's take these one at a time, starting with the carry trade. What is the carry trade? I mean, I think we hear a lot of talk about it in markets, and people have different ideas of what it is. What is it in your view, and how has it kind of manifest in markets?
Well, it's interesting. What the carry trade is the carry trade is almost as long as it has a longevity as long as the history of financial markets. Undertaking the carry trade is something that is it's a natural part. Like, for example, banks, they borrow short at low rates and they lend long at higher rates. That's the carry trade. Now, the carry trade, when it's done in a constrained fashion and for strictly economic purposes, serves a great purpose. That's what the banking system is all about. However, if you reach a point where short-term rates have been artificially depressed for very extended periods of time, naturally what's going to happen is you're going to generate a huge amount of investors. I would call them financial entrepreneurs that are going to use that very cheap funding that's brought about by short-term rates being so low and investing in longer duration assets. And what's happened is you developed entire industries that are basically variations of the carry trade. Obviously, traditionally a carry trade would be you borrow Japanese yen and you invest in Australian bonds or something like that. But now you have private equity. You could make the case that private equity is just one very large carry trade, all being able to be undertaken because of very short-term rates. And there's all sorts of manifestations that go on with the carry trade, including huge distortions of capital flows and things like that. But and I recommend everyone to read that book that came out a couple of years called The Rise of Carry by Lee, and I'm forgetting the name of the third author. But that's a really good book to describe how the carry trade has evolved into what it is today. Now, what's so interesting about the carry trade is it benefits, especially long duration assets, because you can fund them very short duration assets. And what are the interesting funding mechanisms? It's a short duration asset, are natural resource equities. And what you do is you basically say, for example, you run a market neutral portfolio. The carry trades you should invest in, put it 90% technology stocks. If you're market neutral, you got to have short something against it. Short like the XLE against it. And that's why the XLE interest and all these energy stock uh, number of shares outstanding, these ETFs keep going down and down because they're being used as funding mechanisms to fund the carry trade. And so the carry trade has made the bull market in long duration assets, first bonds, and now technology stocks, growth stocks, big cap growth stocks, things like that. But it's depressed short duration assets such as natural resource stocks as they're being used as a funding mechanism. And that's where your opportunity is. That's why this whole period is so exciting.
Yeah, and I just want to pull a quote from one of your recent reports. Most notably, every past carry regime has culminated in a massive mispricing of risk, followed by a violent unwind that inflicted deep losses on investors. And in every instance, the cycle's collapse coincided with the start of a period of sustained natural resource outperformance lasting years. Um, I guess why do you think that this is relevant to where we are right now in markets?
Well, the underlying fundamentals that have created that situation, the unwind of the carry trade and the resulting bull market in commodity related stocks, is there have been basically four major bull markets in commodity prices over the last 120 years. And the first one, ironically, and people don't think about this, started in 1929. And I could actually tell you some fascinating stuffs about that. But, you know, just to show you in that what the unwinding of a carry trade can do and its influence, say, for example, you bought a portfolio of natural resource equities in the summer of 1929, at the very, very peak of the stock market bubble. By 1940, the stock market was down basically, whether it be the Dow or even the beginning part of the S&P 500, which I don't think existed back then. You were by 1940, that portfolio, if it were the Dow Jones Industrial Averages, was still down about 50%. That portfolio of natural resource equities, we just went back and constructed, it was 25% energy, 25% gold, 25% agriculture, and 25% base metals. That portfolio, get this, was up almost 150%.
Oh,
And yeah, and there's a reason why. And the reason why is because you had a massive monetary regime change that took place, which revolved ultimately around the devaluing the U.S. dollar. And what I'm referring to is that Britain was forced off the gold standard in 1929. Stock market crashes. There's a huge banking crisis in the United States in 32, and Roosevelt is forced to raise the gold price to $35 in 1933. So that is like the mother of all monetary regime changes. A former monetary regime change, monetary system, the gold standard in Europe and Britain now is out the window. U.S. is forced to devalue the dollar by 60%, and obviously the huge beneficiary of that was natural resources. The other great time to invest in commodities was the late 1960s. Again, a period where a huge monetary regime change took place. It started. There was huge. At this point, the United States is on the Bretton Woods Gold Exchange Standard. Uh, Europeans, foreign central banks can exchange their excess dollars, bring 35 of them to the treasury, and then get an ounce of gold. U.S. had huge out gold flows because of the very large trade deficits and budget deficits the United States was running in the 1960s. And the first big monetary regime changes, and people sort of forget about this, in 1968. Johnson, just before he announced he was not going to run, he removed the gold backing of the U.S. dollar. The U.S. law said that every dollar outstanding had to be backed 25% by gold. He removed that in 1968. And ultimately, Nixon took the U.S. off the gold exchange standard, Bretton Woods, in 1971. And of course, again, that was a massive monetary regime change that created a huge devaluation of the dollar, and of course produced a sort of like the mother of all commodity bull markets. And finally, in the late 1990s, after a period of excess monetary creation, the Greenspan put things like that. You have the Asian currency crisis, where all the Asian currencies were pegged to the dollar. What had become artificially high rates. They tried to maintain the pegs, they couldn't. They let the pegs go. So the Thai baht from peak to trough, I think declined by 90%. The Indonesian rupiah declined by almost similar amounts, and the South Korean won is similar. Then what happened is that all those Southeast Asian countries decided to suppress the value of their currencies, and they all went from running very large trade deficits to all running very large trade surpluses. Again, people don't talk about it, but it was sort of the monetary regime change that no one talked about. And again, what did that produce? A huge bull market in commodities. Gold went from 250 up to 1900. Oil went from 11 to 145. Copper went from 68 cents ultimately up into the mid $4. So the thing is that we would say that we are on the verge of a huge monetary regime change. And what form it takes, we really don't know. Obviously, there's all sorts of things being floated out there, including revaluing the U.S. gold, Treasury's gold holdings, things like that. So, but it's what's going to happen is that it's going to wind up ultimately with a very large devaluation to the U.S. dollar, which has happened in those three previous ones that I talked about, and it's going to be a massive boost to commodity prices. And I believe that that's what the gold market is telling you today, that a monetary regime change is imminent.
Yeah, and I'm glad you brought up the second catalyst for this I guess commodities boom. We talked about the carry trade, and it goes really hand in hand with this idea of monetary regime change, and really kind of the catalyst for the I guess investor preferences switching from financial assets to natural resources, and the unwinding of the carry trade is all kind of goes hand in hand with this monetary regime change. You mentioned the Nixon shock. I think there's some interesting parallels between today and 1971. I think with Nixon closing the gold window, and then also implementing across the board 10% tariffs on all major trading partners at the time. I think a lot of people forget that part of it. And that there was a similar impetus as to negotiate a devaluation of the dollar. It sure certainly seems like that's similar to kind of what we're hearing about today.
Oh, I agree. In fact, Jesse, I've always said one of the things I tell people is I think we are going to relive the 1970s. I think this bull market in commodities and it is going to be very, very similar to what happened in the 1970s, including a monetary regime change. And of course, it's interesting. The parallels are fascinating. It's the level of inflation that we've experienced in this cycle. When I believe the CPI back in 2023, I think actually hit 10%. However, you read these very, very interesting analysis. If we computed the CPI at the same way we did back in 1972, 73, that would have been a 15 or 16% year-over-year CPI, which is exactly what you experienced in 1974 and 75. So the thing is that the parallels with the 1970s are almost eerie, including, people forget, just like we have the Magnificent Seven and a huge piling into technology growth stocks, we had that back starting in like 1969 with the rising of the Nifty 50.
Right.
The Nifty 50 was like the ultimate growth stock craze, one decision stocks. All you do is buy them and never have to sell them. And that came undone very, very badly starting in the summer of 1972. So the number of parallels that between the 1970s and today, I think are fascinating.
Yeah, and you bring up the fact that it's really the strength in the gold price that is telling us that these catalysts have arrived. I think you've pointed out in some of your research that it's a significant devaluation of the dollar relative to gold that kind of announces the arrival of these regime changes. Do you think that's what the message from? I mean, gold has had a terrific run in the last couple of years. Do you think that's the message from the rapid rise in the gold price right now? Is that these things are underway?
Yes, I do think that, and I think what the rapid rise in the gold price is telling you is that we've printed a lot of money. Obviously, Europe, U.S., Japan have all experimented in radical monetary policy starting post 2008, 2009, where central banks have become huge buyers of financial assets and wound up printing huge amounts of money. And I believe that that's ultimately going to wind up destabilizing the financial markets, and it's going to force a devaluation of a recognition that all this money has to be properly recognized against goods and services and things like that. And that's going to be the devaluation. And I think gold is telling you that right now. And uh, so I believe that if you have any doubt that this commodity bull market is coming, just look at the gold price. That tells you it's coming.
Yeah, one of my things I admire most about your research is some of the ways you look to value commodities. It's so difficult to kind of value them, especially for people like me, with a kind of more traditional approach to equity valuation and things. But when you one chart that I've loved of yours is the value of commodities relative to the stock market, which shows commodities, at the lowest levels on record, essentially still. But then also you compare the oil price to the gold price within the commodities group. Oil looks extremely cheap relative to the gold price. Is that where you believe the real opportunity is within
Yeah,
commodities today?
and I do. And obviously, if you're an investor, I believe that commodities in general are going to go up. However, we obviously are playing the performance game. So what we want to do is we want to invest in the commodities and the related equities in that commodity space that are going to be the outperformers. And I really do believe that in this cycle, that between now and 2030, that the best performing asset class is going to be oil. Now, it's interesting. We'll talk about the underlying fundamentals because you can make a really bullish case for why oil prices are going to go higher. But you mentioned how oil is priced relative to gold, which I find completely fascinating. Now, let's step back a second and let's look at that historical relationship between gold and oil. And we wrote a paper on this a number of years ago, looking back on all the data going back to 1858 when oil emerged as an industrial commodity. And it turns out that roughly speaking, over that entire, I guess that's what, 170-year period, an ounce of gold on average is purchased about 17 barrels of oil. And when oil gets really, really cheap versus gold, that ratio will break 30. That means an ounce of gold will buy 30 barrels of oil. Conversely, when gold becomes very, very cheap relative to oil, that ratio will fall below 10. Now, it's interesting. The number of observations in that 170-year period of above 30 and below 10 are very small, but they do happen. The all-time in the pre 2016, the all-time reading was 40, which an ounce of gold bought 40 barrels of oil, and that was in 1933, right in the midst of the Depression, just after Roosevelt raised the gold price to 35 from 20. Since then, we've been able not only to break through 30, but we've broken through both 30, 40, and 50 multiple times. And I think that it just goes to show you how bearish people are. Back in 2016, right at the end of the last, the market share war waged by Saudi Arabia that started in 2014, that ratio actually hit 45, which was at that time was the highest ever. Then in COVID, prices went negative and went infinite. But if you used Brent instead of WTI, the ratio basically hit 80. Then in the fourth quarter of 2020, it came down and then went back up to 55. And just about a month ago, that ratio hit 58. Now, if you take out the COVID panic in April of 2020, I would say the 58 is the highest the cheapest level of oil relative to gold that we've ever seen. And I believe just like you had that level in 55 in the fourth quarter of 2020, where gold stocks and everything oil stocks and everything oil related led the market for the next 3 years, I think we're on the verge of that happening again. So I think that oil, I'm bullish on gold, but I think that oil and oil related equities will outperform gold and gold related equities. They both outperform the market, but I think oil will do better. And just to show you the converse of that happened back in 2000 to 2003, where gold was ridiculously cheap because all the European banks were selling it. That ratio that I just mentioned, the gold oil ratio, that fell below 10 multiple times. And it got as low as 6.5 in 2003. I think that might be the lowest reading ever in 170 years of history. And if you had bought gold stocks in any during that time period or gold, even though oil outperformed, gold and gold related equities radically outperformed anything oil related. So I think back then you wanted to be gold. This time you want to be oil.
Yeah. And it's just such a great indicator. You look back even to like 2018 and 2022 when it got down to about 15. And it was a great a signal that, hey, this is a great time to be getting bullish in gold and the miners and those
That's
that.
that's exactly right. That's exactly, and I don't think because that whole period in the early 2000s where we had those readings below 10, highly anomalous, and that we probably won't see any of those types of readings in our lifetime. That was all brought about because the European central banks selling, just rushing to sell as much gold as they could, which now in retrospect looks like the stupidest trade they could have ever done.
Right. Yeah, they're all doing the exact opposite now because they want to de-risk
Yeah.
from dollars, which kind of fits
Well,
into
well,
everything we're
well,
talking about.
even somebody like the Swiss who sold half their gold, I mean a huge amount, 1,200 tons between 2000 and 2004, I think their average sale price was like 350. And
Yeah.
here we are almost at 3,500. So
Yeah, it's wild. I want to dig into now kind of some of the fundamentals of the oil market because one of the things that you highlight, and I think this is really crucial, is that everybody's focused on energy demand and worried that if the economy slows, demand for oil is going to go in the toilet. But you point out that it's really what drives long-term cycles in oil is really the supply side. Can you explain how that's played out historically, why it's relevant again today?
yeah, it's very relevant, and this is why we're making a very bullish case, is that the obviously the oil market is dominated by a cartel, OPEC, and OPEC, the biggest competitor to OPEC. I mean, people would say the biggest competitor to OPEC today is the electric vehicle, but we disagree with that. But the biggest competitor to OPEC oil is non-OPEC oil. And when you have periods where oil price, non-OPEC oil supply growth grows strongly, OPEC will oftentimes is threatened by losing market share, and that's when you get low prices, market share wars, things like that. When non-OPEC oil supply growth slows, then OPEC gains market share and pricing power. And I'm going to give you two great examples of that situation at work and how it applies today. Uh, Back in the 1970s, the largest source of non-OPEC oil supply growth in the world, believe it or not, this is hard to believe, was the U.S. Between 1960 and 1970, close to 50% of non-OPEC oil supplies came from the U.S. Then what happened in 1970, U.S. oil supply, which had reached almost 11 million barrels a day, U.S. was by far the largest oil producer, almost double what Saudi Arabia produced back then, that all of a sudden U.S. oil supply stopped growing and actually rolled over. And what happened is that the 1970s was a period of very strong demand growth, beginning part of the decade, Vietnam War still going on, things like that. Uh, OPEC gained market share and pricing power. And in fact, if you go back and look at all the numbers, which people don't do, I believe off the top of my head, OPEC's market share went from like 35% up to close to 40% market share during the decade. And so what happened? OPEC gained huge pricing power. Saudi Arabia pulled the Arab oil embargo in 1973, and then in the late 1970s, you had all the Iranian overthrow of the Shah problems and things like that. And you started the decade in oil at basically $3.50, and you ended the decade with oil almost touching 35. So that's a classic example where a, a unanticipated and pronounced slowdown in non-OPEC oil supply produced the situation that I talked about: OPEC gaining market share and rising prices. The second incident of that is actually in our institutional memory. Starting in the early 2000s, there was a noticeable slowdown about to take place again in non-OPEC oil supply, which was completely missed by the financial analytic and general analytic community in general. From 1990 all the way to like 2003, 60% of all non-OPEC oil supply growth came from the North Sea and the Cantarell field in Mexico. And of course, that those large surges in non-OPEC oil supply put oil into a bear market during almost the entire 1990s. What happened started in the 2002 and 2003. Both those fields, the North Sea and the Cantarell field in Mexico, began to plateau and roll over, except no one understood it. And I like to say, well, there was one person that actually did understand it because, and they say, well, how would you know that? And I said, well, go back to, I think it's January of 2004, an issue of Barron's where there's a huge profile of me in there. And I say that I'm looking for a huge bull market for oil. And why? Because we're going to have this unexpected slowdown in non-OPEC oil supply growth. And that's exactly what happened. And so the thing is that the IEA, International Energy Agency, which is now talking about these huge disappointments in demand, which have not shown up yet, back then was talking about these huge surges in non-OPEC oil supply, which didn't happen. And so what happened? You had a period where demand was growing, OPEC was getting market share, and in 2023, oil was $25 a barrel, and by June of 2008, it hit 145. And that was a huge bull market. Now, here's how it all applies in today. Between 1990 and today, 80% of all non-OPEC oil supply growth has come from the U.S. oil shales. And just like the U.S. conventional oil production rolled over in 1970, just like the North Sea started to roll over in 2022 and 23, 2003, 2 and 3, just like the Cantarell field rolled over, all the oil shales in the United States are in the process of plateauing and rolling over. The only field that has any growth left is the Permian, but our analysis says that the Permian now is in the plateauing process and could very well begin to experience declines starting at the end of this year into 2026. There is no outside of the U.S. oil shales. I mean, there's still a little growth coming from the Canadian oil sands. There's some growth still coming from biofuels, but primarily there is no other oil growth and supply coming from the non-OPEC world. So we're going to enter a world where OPEC is going to begin to get pricing power. How they use it and in what form they use it, we don't quite know, but they're going to be in a very different position than they were between 1990 and 2002, where you had this constant surge of non-OPEC oil supply growth, all brought about by the U.S. oil shales.
It's fascinating because the narrative that you read, in a lot of the mainstream press, I'm starting to see, frankly, some hints of this kind of peeking through the mainstream financial press. There's an op-ed in the Financial Times today talking about this, where another energy expert is arguing that the energy production is expected to peak and roll over. And I think you make the point that it's probably peaking and rolling over even before 2027, which I think is a lot of the estimates that you see. But the mainstream narrative seems to be that the world is awash in oil right now, and that's not going to change anytime soon. How do you, I guess, reconcile your view with this narrative?
I think part of the narrative the reason why people have become so bearish, and they're not, no one's even looking at supply. And it's interesting, and we have done, I think, we have done the best research on the underlying geological forces that are affecting the shale today. And that's a whole discussion that's another discussion. But the thing is, and we're very confident that our research is good, and it's now being validated by the actual slowdowns that we're seeing. We can't get anyone to agree with us. And and so and people in fact, Adam was speaking down at I think it was the petroleum quote in Houston about a couple months ago. He was talking about U.S. natural gas, the rollover that's going to take place in U.S. natural gas, and about two-thirds of the people in the audience, when they polled everyone, do you agree with what Mr. Rosenzweig said? Two-thirds of them said, no, we don't. We don't agree with them at all. And so the thing is that no one is willing to adopt this stance yet. But the reason why I think people don't even pay attention to supply is because everyone's obsessed with demand.
Right.
And everyone, again, the IEA came out with another very, very bearish demand analysis between now and 2030. Basically, peak oil demand is going to happen in the next year or so. Then after that, we're going to start to decline and things like that. And we don't see that at all. And the IEA has been so wrong about demand for it's now going on 15 years that I don't think you should take them seriously. And like here's another great example. I mean, they're talking about um, uh, you know demand weakness and things like that. And they reduced again their demand estimate for 2025. But the thing is, what's also happening, and no one pays any attention to this, is the number of missing barrels in their statements, their income statements, their oil income statements, is now 700,000 barrels a day, which means that demand is now probably running 700,000 barrels a day above their estimates. And so the thing is that again, this will be another year where they wind up severely underestimating global oil demand and be forced to ultimately to raise their estimates. So people have been obsessed with this about this, and it's so important because everyone has bought into the EV narrative that EVs will eventually cause a permanent impairment of global oil demand. And we have researched the subject, and we have approached it from a lot of very creative angles, and we just don't believe it's going to happen. And and now we're getting a Bayesian data point confirmation that our research is correct, in the sense all these big disappointments that are taking place in EV sales on a global basis, except for China, which is a different story.
Yeah.
But the thing is that like think of it very simply as this. The Nissan produces two automobiles. It produces a small, compact internal combustion engine car called the Sentra, and it produces a small, compact EV called the Nissan Leaf. Both cars are exactly the same size, have the both same interior capacity, things like that. Except one is like $23,000. That's the internal combustion engine car. You fill a tank up with gas, and you could drive it 360 miles. The Leaf EV is going to cost you 40,000 with the bigger battery, and maybe you can drive that 190 miles before charge. So you're going to buy a $23,000 car or a $40,000 car, and that's the underlying energy efficiency argument of an EV. It's less efficient, which goes against consensus, but in this case, it shows up in the price. So the thing is, oil demand, we believe, is going to surprise the upside. People are obsessed with it, and they're not paying attention to what's happening on the supply side, which is going to come. It's starting to emerge now as a force. And like you said, Jesse, people are beginning to recognize it. And people are the people that are at the center of it are coming out now and actually, making some very interesting comments. Here's a great example. At the big Zero Week conference down in Houston, several months ago, which is the big energy conference done by Dan Yergin. Scott Sheffield, somebody asked him, why did you sell Pioneer to Exxon? And Scott Sheffield said, we ran out of tier one inventory, or about to run out of tier one inventory. And that's exactly what we're talking about. And, Scott Sheffield was very quiet about, saying that's why he sold it to Exxon, but he said that's why we did it. And you saw the CEO of Diamondback said that they too have run out of tier one inventory. The running out of tier one inventory is what causes will cause the plateauing that's taking place right now and the declines going forward. So we're getting a confirmation points that our analysis is correct.
Well, another confirmation point that I would just bring up that I haven't seen you guys mention, and it's probably just not part of your framework at all, is I follow insider activity very closely, top CEOs and CFOs of companies and their behavior in their own shares. Um, it's energy is really one of the only sectors that's had kind of a persistently bullish profile from an insider standpoint, I think, for the past few years. But also, I think one of the things that's really stood out to me is you have people, these very successful billionaire investors, and if they're buying anything today, it's in the energy sector. You look at, Warren Buffett has $350 billion worth of cash, and the only thing he's been buying is some Occidental Petroleum over the last couple of years. You have Carlos Slim has been buying a ton of PBF Energy consistently over the past couple of years, and you have just a number of these. Who's the other one? Elliott, has been activist in BP and Phillips recently.
Yeah.
And so, to me, some of the smartest investors on the planet really don't want to have much to do with the Magnificent Seven stocks and the rest, but they clearly have a very strong interest in energy. So that's one of the things that I've been really curious about. What is this? What is it driving the smart money to really kind of get ahead of a big boom? And I think you do a great job of outlining what's going on. Let's transition a little bit to you talked about EVs. One statistic that I saw this week was changing the estimates in EV sales. I think last year the estimates were for something like 50% of all auto sales would be EVs by 2030. They've just dropped that to about 25% of EV sales in 2030 will be EVs. So that's a dramatic change in the estimated demand for EVs. And you'd think that would have huge impacts, huge ramifications for demand for energy. And also, I know we want to talk about precious metals and platinum in particular. So the demand side, with this EV thing, I really don't think this is being priced into markets yet, even though the writing is on the wall.
Oh, I agree completely. And I think that, like I said, you have to really uh, roll up your sleeves and do a lot of creative research to understand what are the factors that are going to drive EV adoption and in renewable adoption in general. And what you have to understand is that there's never, ever been an instance where a new technology has been introduced, and like we think EVs are new technology, but they really aren't. But obviously, the last great EV boom ended, I think, in 1912 or something like that. But the there's never been an instance where a new technology has inferior energy efficiency, where that new technology with that energy inefficient technology can displace the old technology. And an EV, like I said, an EV, contrary to what everyone tells you, is less energy efficient when you properly account for all the huge amount of energy that goes into the construction of the battery, the making of the battery, and all the other ancillary things that go with it. And so the idea that will the EVs ever be able to displace the internal combustion engine? No, they can't, except in one scenario. Either you outlaw the internal combustion engine or you incredibly subsidize the EV purchase. Now, we've been trying to do both, and it looks like, as you know, that both of them are in the process of becoming undone. And I think that that's a lot of what is driving the big disappointments that we're seeing.
Right. And it's been interesting to watch over the last few years a company like Toyota, as every other car maker, kind of jumped on the EV bandwagon, and Toyota said, "Hey, wait, this doesn't make any sense. We're going to go all in on hybrids." And it seems like it's really paying off for Toyota now relative to the competition. If we're going to see increased demand, for hybrids relative to kind of the estimates or expectations, what does that mean for platinum? I know you've been very, very bullish on platinum, and it's had a terrific run recently. Do you think that's some of the repricing relative to this demand for hybrids going on?
Yeah, well, the hybrid is a very bullish PGM fundamental backdrop. And you just step back for a second. The reason hybrids are the exact opposite than an EV. If you properly do all the analysis and research, and we have done, and you look at the energy efficiency of a hybrid, it's greater than an internal combustion engine. So this is what Toyota was saying. Toyota knows this, and this is why Toyota came under such criticism of why they were spending all their money on hybrids versus EVs. That they realized that this was going to be the car of the future, and it is. And the thing is I suspect I wouldn't be surprised in 5, 7 years all of us are driving around in hybrids. I mean, they are a more efficient mode of transportation than the internal combustion engine. And that's why hybrid sales are still surging. They're still going up like 30% year over year, where EVs are now turned negative. So the thing is that hybrids are going to come to dominate. Why is this positive for the PGM market? Well, it turns out that a hybrid actually consumes more PGMs in its auto catalytic converter than an internal combustion engine car, depending on how you measure it, between 1 to 2 extra grams. And the reason for that is that a catalytic converter operates at its greatest efficiency when it's very hot. And the problem with a hybrid car is the engine cycles on and off. So the converter, on average, catalytic converter doesn't get as hot. So to get the same efficiency, the same removal of nitrous oxides and unburned material out of the exhaust, you have to increase your PGM loadings. So this is a very, very another bullish factor that's in the whole PGM story. But the EV sales, we're not big. We think EV sales outside of China will continue to disappoint. And you combine the increased hybrid penetration, and you increase the various increase in fuel in various emission standards that are going to be implemented in Europe, China, and India in the next several years, you can make a growth case for PGM demand specifically coming from the whole auto sector. And for those that are interested and have access to it, I recommend highly the research done by Thunder Energy. He has done some excellent work on modeling PGM demand based upon all the things that I just talked about. So it's you could make the case that PGMs, most people have PGM growth actually declining in the next decade. We believe that we could see between 30 and 40% growth in PGM demand because of increased emission standards and the adoption of the hybrid, and the disappointing in EV sale ultimate projections.
Yeah. And when I look at, just to kind of bring it back to some of the other indicators that we've talked about, you look at the gold to platinum ratio, and, platinum, it looks like, in decades has never been this cheap relative to the gold price.
No, it's not. In fact, it's funny, Jesse. I grew up in a world in the 1980s and 1990s. If you go back, the platinum price is hard to believe. On an annual basis, averaged $200 higher than the gold price over that 20-year stretch. And the other day, it basically got to a $2,300 discount. So, I mean, this is interesting because the platinum market's in deficit now, and that a lot of people think it's going to swing back into surplus in 2026 and 27. But the thing is that two things have to happen for that, and this is one of them I think is really interesting, is that you have to have get back to historical amounts of recycled platinum that come back into the market primarily from recycled auto catalysts. And of course, that's fallen by 30% in the last 30 to 40% in the last couple of years because used car prices have gone up so much. And obviously the people are holding on to their cars longer because they have value, and that means they're not scrapped. Used car prices continue to go up. Right now they are going up again. And so the thing is that are you going to get that, other 400,000 ounces of increase in recycled PGM platinum coming back into the market? I don't think so. Now, here's the wild card for 2026, is that most people have completely forgotten about this. I believe it's 2021, one of the big highway spending bills, somebody slipped into that bill that all new cars sold in America in 2026 will have to have a breathalyzer installed in them. Now it's just but people don't know that.
Yeah,
But I keep checking that to make sure that I'm
right.
correct.
Yeah,
And it is. And unless that's repealed, that every car will have a breathalyzer in it. You're going to have to check yourself before the ignition. You're able to start the car. And I guarantee, is that going to put a severe dent in 2026 new car sales? Yes. Is that going to make used car prices go up another notch? Yes. Is that going to reduce the amount of recycled material coming back into the market? Yes. So that source of supply is not coming. And the other thing we have to keep, platinum investment demand, like you said, platinum used to be considered white gold. And it traded a big premium to gold. And
yeah.
platinum demand has fallen off from investment side. Oh, another I think it's close to six or 700,000 ounces in the last several years, and it's going to come back. Everyone's saying the platinum investment demand is coming back. So, I mean, I'm talking about a big, huge bull market that can take place here.
Yeah, and I really think, when you look at the move in gold, it usually leads the broader commodity complex. Let's turn to the agricultural commodities. In your letter, you bring up something called the Gleisberg cycle, which is really pretty interesting. I know neither one of us are meteorologists, or but this is kind of a very interesting concept that has interesting historical precedent. What is it? What does it mean for commodities?
Yeah, an average sunspot cycle is 11 years. And for reasons that people don't quite understand, is that every 8 of those 11-year cycles, you experience the Gleisberg cycle, which is a different amount of sunspot activity that takes place with different amounts of energy that's released from the sun. One of the theories, and this is very controversial, is that the last Gleisberg cycle occurred in the mid 1930s, right in the midst of the Dust Bowl. And there's a lot of people that study solar cycles think that the Gleisberg cycle might have had a significant impact on producing what became as one of the greatest droughts in U.S. history. Now, it's interesting too, is if you go back previous to the 1930s, the other previous Gleisberg cycle happened in the 1840s, and there's not good records, obviously, because the West wasn't settled back then, but they've gone back and done a lot of tree ring studies of that period, and it turns out the 1840s was a period of another extreme drought in the Midwest. So we are now entering the Gleisberg cycle today. Will this wind up producing a very, very large drought condition in the Midwest? And I should point out the Midwest is very dry. We've been dry now for 2 years, and it wound up significantly impacting yields last year. In fact, the USDA had to ultimately reduce their yield assumptions for both corn and soybean by almost 30% last year because of much drier than normal conditions. We're dry again. Do we wind up having another very dry year with a big impact on grain yields? Could be. Now, what's also interesting is that we don't know how the Gleisberg cycle affects other parts of the world, but I should point out that all of Eastern Europe, all of Ukraine, and all of Western Russia, which is obviously a huge grain and wheat growing area, is under extreme drought right now. Most of Brazil is the entire grain growing areas of Brazil are under extreme drought right now. So the thing is that are we beginning to have this global Gleisberg's effect on weather? It's a good question, but I think it's something to really watch closely.
Yeah, it's just something to put on the radar. One thing that struck me is this 80-year idea of an 80-year cycle, which, it's probably no coincidence that we hear about, the possibility of a fourth turning as well, which is also kind of on an 80-year cycle. Ray Dalio talks about, these great debt cycles and, around an 80, 100-year time frame. And so a lot of these things seem to fit together.
That's exactly right. And it's so funny, Jesse, you bring up the fourth turning, because that's a whole nother extremely fascinating issue, another cycle that we're going through right now. So
Yeah,
on top.
and I think what we're talking about, what we have talked about today, is a lot of the components of that. It's an end of the carry trade regime that has persisted for so many years and really come to characterize markets as we know them, and a monetary regime change and all of these things. So, this is fascinating stuff, Leigh. I really appreciate you sharing your expertise with me today. Like I said, I've been looking forward to it and so much, and you've surpassed my expectations. So,
Okay. Well, Jesse, thank you so much for having me on, and hopefully it won't be another 5 years before I get on your show.
yeah, yeah,
So,
yeah. And before I let you go, I keep highlighting your research, and I recommend everybody check this out. Sign up for your letter. Where can people go to kind of, I
yeah,
guess, to do
just
this?
just go on the internet, www.gorozen, that's GOOROZEN.com, and that takes you to the website. Just sign up and you can down everything. There's no
Yeah.
fee. All the research is you download as much as you like, and all there's a lot of podcasts and a lot of other things that are on there that we do. So it's all open to the public. So
As I said, I read your stuff religiously. You're so generous with your research and whatnot, and I thank you very much. I really enjoyed this. Thanks so much, Leigh.
okay, very good. Thank you so much, Jesse. Bye bye.
Now. South on in April of 142!
Remember, for notes and links related to this episode, including Leigh's most recent research report, visit thefelderreport.com/podcast. Thanks for listening, and I'll see you on the financial road less traveled.